The 1973 to 1975 secondary banking crisis in the UK was a significant financial event that had far-reaching consequences for the British banking sector. It was a crisis that primarily affected smaller, so-called secondary banks, which were distinct from the larger, more established clearing banks like Barclays and Lloyds. The crisis was triggered by a combination of factors, including economic instability, rising interest rates, and speculative lending practices by secondary banks. These smaller banks had engaged in risky and aggressive lending, often providing loans for property and real estate ventures. As economic conditions deteriorated, many of these loans turned bad, leading to a wave of defaults and financial stress among secondary banks.
The crisis came to a head in 1973 when one of the most prominent secondary banks, the London-based Herseth Bank, faced severe liquidity problems and was unable to meet its financial obligations. This event caused a panic in the financial markets and led to a loss of confidence in secondary banks. Its effects include bank failures, consolidation, regulatory reforms, and a negative impact on the broader economy. This crisis played a significant role in shaping the regulatory framework and the financial landscape in the UK in the years that followed.
The combination of regulatory changes, financial support, and consolidation efforts helped the UK recover from the 1973 to 1975 secondary banking crisis and laid the groundwork for a more robust and regulated financial system in the years that followed. These are the Bank of England support, regulatory reforms, Banking Act 1974, banking sector consolidation, depositor protection, rebuilding confidence, economic stabilization, and long-term regulatory reforms. The crisis also served as a learning experience for policymakers and regulators, emphasizing the importance of prudent banking practices and effective supervision. Address of crisis, the Bank of England took a series of measures, including providing financial support to troubled banks and implementing regulatory changes to prevent a similar future in the future. The crisis ultimately resulted in the merger and consolidation of several secondary banks, reducing their number and size in the British banking sector. Measures instituted to prevent its occurrence in the upcoming, including regulatory framework, prudential regulation, supervision and monitoring, deposit protection, early warning systems, resolution framework, risk management practices, market transparency, macroeconomic policies, and international coordination. These measures collectively aimed to create a more robust and resilient financial system that could better withstand economic shocks and mitigate the risk of another secondary banking crisis. Over time, these reforms contributed to the stability and soundness of the UK banking sector and serve as lessons for regulatory improvements in the global financial industry.